The story begins with a moment that appears ordinary at first, but carries deeper meaning. A person walks into a coin shop with the price of silver showing $76 on a mobile phone. There is no negotiation and no discussion of discounts or spreads. Instead, the dealer closes the door and states clearly that the silver cannot be purchased that day. That single refusal reflects more about current conditions in the silver market than any chart or price graph. What is unfolding is not a cooling of prices, but a breakdown in the movement of physical supply. Across multiple locations, similar behavior is being reported. Major dealers have either stopped buying silver altogether or are placing bids far below the quoted spot price. At the same time, those same dealers are selling silver at prices above spot, in some cases far above it. This situation shows that the silver market is no longer operating as one unified system. Instead, it has divided into two separate spaces. One exists on screens through paper contracts and reference prices. The other exists in the physical world, where silver must be sourced, handled, and delivered. When a market separates in this way, it does not adjust quietly. To understand why dealers are refusing to buy, it is important to understand how their business normally functions. A coin shop is not designed to store large amounts of metal for long periods. It operates as a flow-through business. Dealers buy from the public and quickly sell that metal to wholesalers. Wholesalers then move the material to refineries. Refineries process coins, scrap, and mixed lots into refined bars. This system depends on continuous movement. When a dealer says they cannot buy, it signals that this movement has stopped somewhere along the chain. The reason for the stoppage is not fear or negative sentiment. It is a mechanical problem tied to financing. Refineries rely on borrowed physical silver, while incoming material is melted and refined. This borrowing allows them to meet delivery obligations during processing. The cost of borrowing silver is known as the lease rate. Under normal conditions, lease rates remain low and attract little attention. However, lease rates have surged sharply, reaching extremely high levels. This signals that physical silver available for lending has become difficult to find. When borrowing costs rise to that degree, refining becomes unprofitable. Faced with these conditions, refineries begin rejecting new material. Wholesalers then stop accepting shipments. Dealers, unable to move inventory downstream, either stop bidding altogether or offer prices far below spot. The result is a sudden loss of liquidity for sellers. This demonstrates that liquidity is not guaranteed. It exists only when the system is functioning smoothly. Another clear signal appears in the relationship between spot prices and futures prices. In a healthy commodity market, future delivery usually costs more than immediate delivery. That structure reflects storage, financing, and time. However, when physical supply becomes tight, this relationship can reverse. Spot prices rise above futures prices, a condition known as backwardation. In simple terms, it means immediate delivery is more valuable than promised delivery later. This reflects urgency and scarcity, not expectations. Once this condition appears, its impact spreads throughout the system. Refiners lose the ability to hedge efficiently. Wholesalers struggle to price inventory. Dealers cannot confidently offer buybacks without risking losses they cannot absorb. As a result, spreads widen sharply. Some dealers ration purchases, while others pause buying entirely. These actions are not signs of manipulation. They are responses to survival pressures inside a stressed system. The difference between paper ownership and physical ownership also becomes critical. Some products represent claims on silver. Others represent specific bars held in vaults. During stable periods, this distinction may seem theoretical. Under stress, it becomes decisive. When many holders attempt to exit at once, paper claims compete with each other. Physical bars do not multiply. This dynamic explains how paper prices can decline even as real-world scarcity intensifies. Forced selling in paper markets can push reference prices lower. Margin requirements trigger liquidations, creating selling pressure on screens. At the same time, physical silver remains difficult to obtain. This produces a situation where quoted prices fall while dealer premiums rise. The screen shows one reality, the street shows another. These are not conflicting opinions. They are the result of different mechanisms operating at the same time. This leads to a series of contradictions that cannot be ignored. If silver were truly easy to sell, dealers would not be refusing to buy. If supply were abundant, premiums would not be expanding. If the system were functioning normally, spreads would not resemble gaps. What is being observed is a market where paper indicators suggest calm, while physical transactions reflect strain. That gap is the core issue. Reference prices are formed in paper markets involving futures, swaps, exchange-traded products, and algorithmic trading. Paper supply can expand rapidly. Physical supply cannot. When physical silver becomes scarce, paper activity often increases rather than decreases. Volume grows. Contracts multiply. Noise rises. Meanwhile, the physical side struggles to deliver. This disconnect creates the conditions now being seen. As the situation develops further, additional forces are adding pressure to an already strained system. Beyond trading behavior and supply mechanics, demand itself is changing in ways that limit flexibility. Silver is no longer used only for coins, jewelry, or investment products. It is now a key material in solar technology, electronics, power management systems, and modern hardware infrastructure. These uses are not optional. When silver is unavailable, production lines stop. This makes industrial demand rigid rather than flexible. Buyers in these sectors do not reduce purchases because of price movement. They buy because operations depend on it. When rigid demand meets a supply bottleneck, the outcome is not gradual adjustment. It is sudden strain. Alongside industrial demand, there is another layer influencing supply behavior. Governments are increasingly treating certain raw materials as strategic resources. When metals are placed under export controls, licensing systems, or strategic classifications, normal market behavior changes. Supply no longer flows freely toward the highest bidder. Instead, it moves toward approved or prioritized buyers. This is allocation, not open liquidity. Under allocation, access matters more than price. In these conditions, the assumption that silver can always be sold anywhere becomes unreliable. That assumption only holds when the system is under low stress. When stress increases, the question shifts from price to access. Who has refinery slots available? Who has financing in place? Who has established relationships within the supply chain? In a squeeze, these factors determine outcomes. Price becomes secondary. This explains why higher prices do not automatically restore liquidity. Rising prices increase the cost of carrying inventory. They raise margin requirements in paper markets. They attract political attention. Rather than easing shortages, higher prices can expose them further. At the retail level, this stress appears through premiums. Premiums are not behaving as if supply is slightly constrained. They are acting as rationing tools. When a 1-ounce coin sells far above the reference price, it signals that retail access is still possible, but only at a cost designed to slow demand. At the same time, when dealers bid far below spot, it signals uncertainty about their ability to exit positions. These two prices are not expressions of profit. They are expressions of risk management. There is a common misunderstanding that high premiums mean silver itself is overpriced. In reality, the premium reflects the cost of immediacy. It reflects thin inventory and uncertain delivery. Premiums can remain elevated even if paper prices decline. This creates a situation where buyers believe they are purchasing at a discount, while still paying historically high total costs. The reference price remains only a guide. The actual transaction price is determined by availability. This distinction highlights an important principle. The spot price functions as a reference, not a guarantee. Physical silver trades with real, world spreads that expand under stress. As conditions tighten, the effective price becomes the price of delivery rather than the price of a claim. This shift changes how risk must be evaluated. Availability, wait times, and buyback policies become more important indicators than headline prices. There is also a psychological trap present in these conditions. Many focus on debating where silver should be priced numerically. Meanwhile, the critical decisions are happening away from public view. Refineries are deciding what material to accept. Wholesalers are deciding what inventory to carry. Financing providers are deciding what risks they are willing to support. These decisions shape outcomes long before prices adjust visibly. Dealer behavior during this phase is often misunderstood. A bid below spot is not always driven by greed. It can be driven by survival. When a dealer buys silver, they assume several risks at once. There is price risk if the reference price moves against them. There is outlet risk if downstream buyers refuse shipments. There is timing risk if capital becomes locked in inventory for extended periods. Under stress, dealers respond by stepping back or by offering prices that only urgent sellers will accept. This is not a normal trading environment. It is triage. The paper market can intensify these distortions. When exchanges raise margin requirements, they do not create new physical supply. They force traders to post additional cash. Those unable to meet requirements are liquidated. Liquidations increase selling pressure in paper markets, pushing reference prices lower. Physical supply remains unchanged. This creates the unusual outcome where prices appear weaker while availability worsens. The screen shows decline. The shelf shows scarcity. In such conditions, volatility becomes a tool of the system rather than a signal of balance. Sharp moves shake out leveraged participants. Cash settlement becomes more attractive than delivery. Ownership turns from a passive position into an active responsibility. These shifts occur without announcement. They emerge through behavior. Understanding what is actually owned becomes critical. Physical silver is not designed for short-term trading. It is not structured for instant liquidity during stress. Its value lies in optionality and certainty of possession. When paper promises are questioned, physical ownership behaves differently. This difference is now visible through spreads and access limitations. Liquidity must also be reassessed realistically. The assumption that silver can always be sold immediately at spot is proving unreliable. Time, location, and counterparties matter. Knowing in advance who buys, under what conditions, and during which phases of the market becomes essential. Testing liquidity before it is needed is a practical necessity. As these pressures converge, a larger structural question emerges. There is a possibility that the division between paper and physical markets becomes lasting rather than temporary. Paper instruments may continue to dominate trading activity. Physical supply may increasingly be directed toward industrial use and strategic reserves. In such a structure, retail buyers operate in a constrained segment where access is limited and costs are higher. This does not require misconduct or hidden agendas to occur. It is the result of incentives. Industry seeks certainty of supply. Financial institutions seek risk control. Governments seek strategic security. Retail participants seek fair pricing. When supply is abundant, these goals coexist. When supply tightens, they compete. Competition forces prioritization. The clearest signals in this environment are not headlines or forecasts. They are refusals, delays, and widening spreads. When a dealer cannot buy at the quoted price, the system is revealing its internal condition. When premiums rise independently of spot, scarcity is being priced directly. When lease rates surge, metal is difficult to source. As this report concludes, the situation remains defined by stress beneath stable, looking reference prices. The focus is not on predicting the next move, but on recognizing the signals already present. Markets under strain do not announce transitions in advance. They reveal them through behavior. In moments like this, the most important indicators are access, movement, and trust. When those weaken, the market is not malfunctioning. It is showing what it truly is under pressure.